Everything they have, they can pay it off today if they wanted to and still have heaps of cash left over. So they're in a really strong financial position here. Hey everyone, we've got a really challenging company to look at today in Nautilus, which is the fitness equipment manufacturer and seller. Look, I'm gonna do my quick valuation, go through my 9-point checklist, and then give you my opinion at the end with a buy price. But look, this is challenging and I'll show you why as we go through it. Some facts about Nautilus are that, well, look, the fitness trend has been a big winner of pandemic times. It's pretty obvious everyone needs to work at home, so fitness equipment at home is going to be a hot seller. So they're definitely going to have benefited from this. It's about a $330 million market cap as it stands at the moment. So it's a small cap company. There's been new management from 2019. So this is a bit of a turnaround play. Look, Peloton, Nordic Track, Echelon are taking a lot of the attention. Nautilus has sort of been left behind a little bit as one of the brands in this space. The question I'm going to have is, I don't know what their competitive advantage is. I'm going to have a look through the fundamentals to see whether I can see if they might have a competitive advantage looking at the numbers, but that's probably where the digging is going to be needed. So let's go and have a look at the revenue growth to see what's been going on there. Now, for the last 10 years, well, 10 years ago, it was 180 million. Now it's up to, looks like it's going to be 550 million. So that would be a tick. But the last few years, as you can see, it was 2016, 2017 at 406 million. In 2018, it went down to 397. 2019 down to just 300 million. So it was declining. It had lost 25% of its revenue. And then it spiked back up. It's gone 60-70% up since then. So that's obviously pandemic related, but I don't really know whether that's revenue growth or not because it was sort of declining and then the pandemic. So what is normal growth? I don't know. I don't know what the normal revenue number is. Maybe this company is, I don't know, maybe it was dying and the pandemic has just prolonged that a little bit longer. I don't know. So I'm gonna have to give that, I guess, a question mark. I can't give it a tick and I can't give it a cross. So let's just give it a question mark. All right, next thing is gross margins. Now, it's probably gonna be a similar story here. So yeah, 2016, 27, we've got 50% in the 50% numbers here for gross margins. Then it's gone all the way down to 35%. So they might have been lowering their prices to try to compete, increase competition. Margins have gone back up above 40%, which is what I like to see. But again, I don't know, this is pandemic related. So I'm just gonna have to give that a question mark again. So sorry about this one. This is why it's a bit tricky. Next up is return on invested capital. I'm gonna have to give this a question mark as well, I'm sure, but let's have a quick look. Yeah, okay, so 2019, it was minus 53%. 2018, it was 6%. It's been all over the place. It's been up, it's been down. It was falling apart in 2018, 2019. They've obviously in 2019 spent a heap of money trying to, that new management team came in 2019. They're probably spending a lot to, I don't know, reinvent the brand, maybe bring out some new product lines. I don't know. It's jumped back up to nearly 40%. I don't know. Let's give it a question mark again. This is pretty hard. So anyway, we'll see how we go. So let's go have a look at debt. And debt is obviously very important. This is how companies get into trouble. So we want to see current assets above current liabilities, and it's fantastic. It's 300 million compared to only 130 million in liabilities. So yeah, fantastic in terms of the short-term debt. And they don't have, look, their short-term assets can cover their long-term all their liabilities. Everything they have, they can pay it off today if they wanted to and still have heaps of cash left over. So they're in a really strong financial position here. I think they obviously just made a lot more money than they were expecting. Therefore, their cash balance just skyrocketed. Yeah, really good news there. That's a big tick, actually. That makes me gonna look at this a little bit more, and this is pretty interesting now. So, all right, free cash flow. Free cash flow we have, look, it's gonna be a similar story. Yep, as we can see, in 2019, it was down at minus 32 million. It had been higher, then it was declining, went down. They obviously were spending a heap of money here. Actually, they weren't. They only spent $9 million in capital spending. I don't know what's going on here. I'm gonna have to dig into this to work this out because it's jumped back up to $60 million. So that's pandemic related, obviously. I don't know why 2019 was such a bad year. Anyway, free cash flow, don't know. Now, if you're wondering what brokerage accounts that I use to buy and sell and hold my shares is, I use Interactive Brokers and Saxo Bank. Interactive Brokers is my preference. I have a link in the description. If you want to go and have a look at a demo account and play around with it a little bit, yeah, it's the account that I use personally. That's why I'm happy to talk about it. The reason I love it is because it's got a long history. It's gone through ups and downs before, so I know it's going to be safe. They have a great balance sheet as well. It's actually a publicly listed company, so I can actually look through the financials and see how safe it is. Just like I'm doing a valuation of these companies, I can do one of Interactive Brokers, which is cool. I can't do that with Robinhood or Webull or anything like that. Actually, I can just now do it with Robinhood because they've gone public, but look, they're essentially a startup. So I like Interactive Brokers since they've been around since the 70s. It also gives me access to international markets, unlike those other platforms that I just mentioned, like Robinhood. Access to international markets is really important for me as an investor, and the fees are really low. So yep, that's my preferred brokerage account. Saxo Bank is good as well. I have it as my secondary account. Now back to my checklist, the next thing is shares outstanding. So I want to see this number stable. If it's getting bigger, it means that we're getting diluted. If it's getting smaller, it means that our value is actually increasing. So we've actually had pretty much flat line. It was 31 million 10 years ago. It's 32 million now. That hasn't changed essentially. I'm happy to give that a tick. They're not issuing any more shares really, and they're not buying them back, so that's fine, give that a tick. Next thing is insider ownership. So I want the incentives of the management team aligned with us as shareholders. So look, their compensation needs to be about 1/10 less than the ownership in the company. That's how I look at it. So the CEO, actually if I look at all of these, their ownership percentages are small. The CEO has $1.7 million worth of shares, but his compensation is $3 million. So if the share price goes down, it doesn't really matter for his net worth. The incentives are different. I would like to see that ownership percentage at like 30 million compared to that compensation package. So I'm going to have to give that across. That's not good enough. I want better incentives from the management team. The next thing I check for are whether there's any super investors invested in this company. And I had a look, I looked around for this, but I couldn't find any of the super value investors that I follow. None of them have invested in the company. So look, I have to give that across. The reason I look for this is this would give me more conviction because look, I'm not that smart, but if someone who has had decades of experience has invested in the company, well, that would make me a little bit more interested. But in this case, we don't have that. So we just have to move on to the next part of the checklist, which is price. And price is the most important thing. Regardless of what this company looks like, it could be a good or a bad investment based on the price we're going to pay. So to do that, I look at my intrinsic value calculator and I put in some growth rates that I think is going to continue growing at. Now, that was extraordinarily difficult because I have no idea what the growth rates are. What is normalized growth for this company? Because 2016 to 2019, it was declining and then it's jumped up dramatically. So if I look at the last 10 years, it's grown at like 5%, but there's some ups and downs in the way, and I don't know what normalized is, but let's go on the optimistic side and say it is actually going to grow from its current pandemic levels. So I would have growth rates of 5%. My return on investment goal is 30%. Now it's really high as a discount rate. The reason I have it so high is because I'm actually aiming for in the 20% range, and this builds in some margin safety for me. Now the multiple I'm going to sell it for, it's a multiple of free cash flow. Just because these growth rates are low, I can only probably get a 10 for this. I've put in the free cash flow number, the shares outstanding, the cash and the debt. And it tells me I want to buy this at around about $10. And if I go look at the current price, it is actually about $10. It's a little over that, but it's in the ballpark. So that's very interesting. But as you can see, I was really optimistic. I don't know whether these growth rates, I actually think it could easily be negative 5% and zero. Let's say it flattens out, the management team do get on top of it, and I don't know. Remember, these pandemic numbers are probably a one-off, so it's probably not going to be able to keep up to this level. So the average free cash flow for the last 5 years is actually only about 30. So $30 million per year on average for the last 5 years. So if we use that average and we assume it's going to decline a little bit in the future and maybe flatten out, let's just say it even stays flat. We really should be only buying this based on the fact that they have a pretty big cash balance and making around about $30 million a year in free cash flow. We want to buy this about $5, and that's about half. That would mean the share price would have to fall about in half from here. So yeah, this one's really tricky. This is why it's difficult. I would feel a lot more comfortable at $5, but whether we ever see that, I have no idea. I don't really know what I think of this company, I'll be honest. So this actually would require a fair bit more digging. So my overall opinion is that, look, I guess it's an attractive price if they can hold that position that they currently have, but look, there's no super investors, so I can't get any help here. I think there's too many question marks for me. I don't know what their unique competitive advantage is. Maybe they've formed something in the last couple of years. Maybe they have a niche now, I don't know. I think the business is going to be challenging for them. There's a lot of competitors in the space as well. I don't see an easy path for them to success over the next decade. Again, I'd have to look into the management team and what's going on in this company, what new stuff they've got coming out. This is tough. And I don't think this is also an asset play where it's like you're buying a 50 cent dollar, until we see the comparisons to 2020. So if 2021 results come out and they're in line with 2020, well, maybe they are holding a competitive advantage or holding some market share that they have or something. But I think the pandemic's a one-off boost for them, and I don't know what normal looks like. So yeah, there you go. That's my overall opinion. Price is probably okay if you're really confident, but for me, price is probably not okay. I hope you enjoyed this video. I hope you got some value out of it. Make sure you hit the like button before you go, and I'll see you in the next video.